Welcome back to Investing Talk Podcast.
Today we're looking at a major dividend-focused exchange-traded fund, often cited as the king of dividend ETFs.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. The foundation of this fund, really the core of its whole appeal, is its rules-based methodology.
Okay.
It tracks an index of 100 high-dividend U.S. companies. But here's the key part. It's not just about the yield.
There's a quality screen, right?
Exactly. They only pick companies with, proven financial health, and this is crucial, at least 10 straight years of dividend increase.
10 years. So that immediately sets a really high bar. It positions the fund squarely in the value camp.
It does.
And you can see that when you look at the valuation metrics. The weighted average PE ratio is just 15.50.
Which is a massive point of distinction, especially right now. The broader S&P 500 has been trading much, much higher than that.
Yeah, closer to 20, sometimes even more.
So you're not chasing those expensive, high-flying growth stocks. You're basically buying stability at a pretty significant discount.
But doesn't that mean you miss out on some newer companies? Maybe a great tech company that's only been paying a dividend for, say, 5 years?
That's a great question. And yeah, that's the trade-off. You're sacrificing that potential early growth from new dividend payers.
For certainty.
For the certainty of established, consistent payers. It's a clear choice for stability over speculation. And you see that defensive approach reflected in the sector breakdown.
So what sectors are really dominating the fund now?
What stands out is the heavy weighting to defensive and cyclical value plays. Energy is actually the largest sector at 19.3%.
Wow, that's a big allocation.
It is, and that's followed by consumer staples and healthcare.
Yeah.
The whole thing is just built to hold up better when the market gets volatile.
And that resilience, it really shows up when you look at the performance history. It's weathered the recent market choppiness surprisingly well. As of late November, the year-to-date return was a positive 4.08%. In a year like this one, that kind of stability is pretty valuable.
But where it really earns that king nickname is the long-term view. This is sustained compound growth. I mean, we're talking annualized returns of 9.48% over the last 5 years.
That's a figure that beats inflation pretty handily and competes with a lot of non-dividend benchmarks.
It absolutely does, all while it's paying you that current income.
So let's shift from the structure to the financial health. We need to know these companies can actually afford to keep making these payments, right? Especially if the economy slows.
Absolutely. The quality screen isn't just about the history of paying. It's about the ability to keep paying and growing them. This is where we look at profitability, specifically return on equity or ROE.
And the ROE for these holdings is high.
Exceptionally high. The weighted average ROE is 28.71%.
Oh.
Okay, that is a massive number. Can you break down what that really tells us? Sure. Think of it as efficiency. For every dollar of equity in the business, these companies are generating almost 29 cents in profit.
Wow.
It's phenomenal. It means they're generating serious free cash flow. They're building a financial fortress, which is exactly what you need to sustain and grow dividends through a recession.
And that stability is definitely reflected in the fund size. The total assets under management is huge, $72.02 billion.
It's a true anchor investment for a lot of people. And if we dig into the dividend metrics themselves, the current yield, trailing 12 months, it hovers around 3.8% to 3.9%.
Which is very attractive. And the payout ratio seems healthy, too.
Very healthy. It's at 58.76%. That means there's a huge buffer, about 41 cents on every dollar of earnings, for companies to reinvest or just absorb economic shocks without having to, cut the dividend.
And what's the growth outlook?
This is maybe the most interesting part.
Yeah.
Analyst consensus points to annual dividend growth of 9.15%.
So you're not just buying today's 3.8% yield, you're buying an income stream that's projected to grow at nearly double the rate of inflation.
That's the idea. And this all ties into that concept of a moat. This whole selection process creates a layer of protection. You're buying sustainable high yield, not just high yield.
Which protects you from the classic yield trap.
Exactly. Where a company is paying a huge dividend right before it all falls apart.
Yeah.
And we can't forget the expense ratio. It's just 0.06% for a long-term compounding strategy. Keeping fees that low is essential.
So we've got the fundamentals, we've got the financial health. What are the technical FERTs telling us right now?
Shifting over to the technicals, the picture is still pretty constructive. The fund has a really low volatility, It's got a beta of 0.75.
So just to clarify for everyone, that means if the S&P 500 drops by, say, 10%, this fund would historically only drop by 7.5%. It's a cushion.
It's a cushion,
Mm.
precisely. And that's a huge selling point. Now, the price itself, as of late December, it's trading in the high $27 range.
Okay.
What's really noteworthy is its resilience. Despite some pullbacks, it has consistently been forming higher lows. That tells you buyers are stepping in at higher and higher prices.
A sign of underlying strength. So where are the key levels a buyer should watch?
There's a key support level right around $27.57. For someone looking for an entry point, that level offers a pretty clear risk-reward setup.
And what about momentum?
The moving averages look good. The 50-day and 200-day are in a good alignment, suggesting the long-term trend is still intact. Well, what's more interesting are some of the hidden divergences in indicators, like the RSI or MACD.
Can you explain what a hidden divergence is?
Yeah, simply put, it's when the price might be making a new low, but the indicator that measures the strength of that move is actually making a higher low. It suggests the selling pressure is running out of steam.
So the pullbacks are more like healthy resets.
That's what it looks like. And this all feeds into the upside potential. Analysts are seeing a potential return between 10.66% and 12.27% from here.
And that's on top of the dividend.
On top of the dividend.
So how is the market actually perceiving this fund? Sentiment is described as somewhat bullish, but there's been a lot of positive press calling it the top high-yield ETF.
That positive press is definitely there. But we have to look at the money flows, which have been volatile, to say the least.
Right, I saw that. There was a huge $1 billion inflow mid-December.
Followed almost immediately by $991 million in outflows just before Christmas.
$1 billion walking out the door sounds like a red flag. Why wouldn't that be a major concern?
It's a fair question, but you have to look at how the price reacted. It didn't collapse. It held those key support levels we talked about.
So it wasn't panic selling.
Doesn't look like it. It suggests institutional rotation, big money moving things around, maybe rebalancing. It could even be capital moving out of overvalued tech and getting redeployed back into quality defensives like this. It's professional maneuvering, not a loss of faith.
Okay, that makes sense. Which brings us to the catalysts for next year. What's the big one?
The biggest macro factor, without a doubt, is the potential for Federal Reserve rate cuts in 2026. This fund is almost perfectly positioned for that.
Because of that heavy weighting in rate-sensitive sectors like energy and utilities, right?
Exactly. When borrowing costs fall, those sectors tend to get a nice tailwind.
So that 19.3% in energy isn't just a random allocation, it's a potential catalyst.
A major one. If the market keeps rotating away from tech and back toward value, this fund is structurally built to benefit from that shift.
Okay, but every investment has risks. What's the bear case here?
The biggest risk is the flip side of that catalyst, the heavy energy exposure. It's a double-edged sword.
So if oil prices get volatile or if those Fed rate cuts get delayed,
then that sector concentration could become a significant performance drag. It's the single biggest risk factor.
And what about those outflows? Even if they are rotational, doesn't nearly $1 billion create some short-term uncertainty?
It creates some noise, for sure. But the fund's valuation, that low PE of 15.5, it provides a buffer. You could argue that any short-term friction is already priced in, and historically this fund has recovered very strongly from drawdowns.
So let's tie this all together. What is the central investment thesis here?
It's pretty clear. You're getting superior dividend sustainability combined with strong downside protection. You have a solid 3.8% yield today, but it comes with a projected 9.15% annual growth rate.
All backed by high-quality companies at a discount.
Right. It remains, I think, the premier buy and hold option for anyone focused on compounding income over long term.
And that long-term horizon is key. This isn't a short-term trade. It's about letting that dividend compound year after year and acting as a stable anchor in your portfolio.
It's an asset that lets you participate in the upside, but really proves its worth during the downturns by cushioning the fall and continuing to grow your income stream.
It really demonstrates the power of having a strict, rules-based process. It's a stable bridge between quality value stocks and consistent growing income.
If you found this analysis helpful, make sure to subscribe to Investing Talk podcast for more detailed breakdowns.